Welcome back to another episode of the Disciplined Trader Collection podcast, brought to you by Bell's Forex Audio Works, where we transform complexity into clarity and volatility into opportunity. I'm your host, Isabel Maria, a fellow trader who's weathered more than a few stormy markets, and today, we're diving deep into one of the most critical skills any serious trader must master: how to navigate market volatility. Volatility, it's that word that can make even seasoned traders tighten their grip on the mouse. It's the market's emotional heartbeat, fast, unpredictable, and at times, exhilarating. But here's the twist: volatility isn't the villain. In fact, it's the very thing that creates opportunity. If you learn to adapt your strategy, volatility can become your greatest ally. As Warren Buffett famously said, "Be fearful when others are greedy, and greedy when others are fearful." It's a mantra that separates impulsive traders from disciplined ones. Because the truth is, when fear floods the market, logic often leaves the room, and that's where disciplined traders find their edge. Let's start by demystifying what volatility really means. It's the measure of how fast and how far prices move, the market's mood swings, if you will. When the VIX, the so-called fear index, spikes, it tells us that investors expect rough waters ahead. And those waves can be triggered by anything: inflation numbers, central bank meetings, or even a tweet that changes global sentiment overnight. Now, here's where things get personal. Benjamin Graham once said, "The investor's chief problem, and even his worst enemy, is likely to be himself." No truer words have ever been spoken. Because during volatile times, your biggest battle isn't with the market, it's with your own reactions. Fear of loss, overconfidence, hesitation, all of these emotions can distort your judgment faster than a flash crash. That's why the first step in mastering volatility is risk management. Think of it as your trading seatbelt. You might not always need it, but when you do, it can save your portfolio. Let's talk position sizing. When markets are swinging wildly, smaller is safer. Reducing your trade size allows you to stay flexible and prevents a single bad move from taking you out of the game. Then there's the humble stop-loss order, your silent guardian. But it has to be smart. Too tight, and normal price noise will knock you out. Too loose, and your capital evaporates. The key is finding that balance between risk and breathing room. And, of course, the risk-to-reward ratio, the golden rule. As trader Paul Tudor Jones once said, "Don't focus on making money, focus on protecting what you have." Every trade should earn its place in your portfolio by offering at least twice the reward for the risk you're taking. That's how you stay profitable in the long run, especially when the market's mood swings like a pendulum. Let me bring this to life with a quick story. Back in March 2020, when global markets went into freefall, a colleague of mine, we'll call him David, decided not to panic. While many traders were dumping positions and burning capital, David zoomed out. He reduced his position sizes, used the average true range to dynamically set his stop losses, and stayed laser-focused on liquidity. Yes, he took a few hits early on, but he preserved enough capital to ride the recovery that followed. His composure turned chaos into opportunity. That's the power of discipline when everyone else is driven by emotion. Now, let's pivot to technical analysis, because this is where the tools meet the tactics. Indicators like Bollinger Bands or ATR are essential in high volatility environments. They tell you when price is stretching too far, too fast, and when it's likely to snap back. Combine them with trend confirmation tools, moving averages, MACD crossovers, RSI divergences, and you start filtering noise from signal, but don't underestimate the importance of support and resistance. These levels act like psychological barriers for traders. When price approaches them during volatile periods, tension builds, and the market often reacts sharply. A breakout or a rejection at those points can define your next profitable trade. So, how do you trade volatility? You adapt your strategy to it. Scalpers thrive in fast-moving conditions, jumping in and out to capture those micro moves. Swing traders, on the other hand, can ride broader waves, catching multi-day swings between established zones. And then there are the trend followers, traders who align themselves with the dominant direction and ride it until the market itself decides to change course. Each style can work, as long as you respect risk and stay emotionally neutral. Of course, fundamentals play their part too. Volatility doesn't emerge from thin air. It's often born from economic surprises, policy shifts, or geopolitical shocks. That's why you must track economic indicators, GDP, inflation, interest rates. A surprise jobs report or a central bank hint can change market structure in minutes, and when earnings season hits, volatility loves to make an appearance. One surprise earnings miss from a major company can ripple through an entire index. As Peter Lynch put it, know what you own, and know why you own it. In volatile markets, ignorance is expensive. Now, let's talk about the mental game, psychological resilience. Trading volatility is like surfing. You can't control the waves, but you can control your balance. Staying grounded means managing stress before it manages you. Mindfulness, regular breaks, even something as simple as stepping away from the screen, these things help you trade with clarity, and above all, stick to your trading plan. A written plan is your anchor. When emotions rise, the plan keeps you rational. It defines your entries, exits, and risk parameters, so when chaos hits, you already know what to do. That's what separates the professional from the panicked. Then there's the tech side, your advanced tools. In fast-moving markets, algorithmic systems can execute with precision humans can't match. Backtesting helps you refine strategies before real capital is on the line. And a robust trading platform with live data and advanced charting gives you the situational awareness to react decisively, not impulsively. As Howard Marks once said, the biggest investing errors come not from factors that are informational or analytical, but from those that are psychological. Let that sink in. Your edge isn't just in your indicators, it's in your mindset. So here's a question for you, and I'd love to hear your take in the comments down below. When volatility spikes, what's your go-to move? Do you sit it out, scale in, or hunt for opportunities others are too scared to touch? Because mastering market volatility isn't about avoiding turbulence, it's about learning to fly through it. Until next time, stay disciplined, stay data-driven, and let volatility work for you, not against you.
Thank you for listening to The Disciplined Trader, brought to you by bellsforex.com AudioWorks. We hope this episode gave you insights, perspective, and practical ideas to strengthen your trading mindset and improve your decision-making. Stay disciplined, keep learning, and remember, every trade is a step toward building your edge. If you found value in today's episode, don't forget to like, subscribe, and turn on notifications. Sharing the podcast with fellow traders helps us grow and bring even more free trading education to the community. Visit us anytime at bellsforex.com for resources, guides, and tools to support your trading journey. Until next time, trade smart, stay disciplined, and keep building your edge. Happy trading.